Good day, this is Sean Carson, investment realtor with eXp Realty. So I'm here today to show you kind of what I do on the daily. And in regards to portfolio analysis, is I will identify what my clients and investors' real estate portfolio looks like and start giving recommendations for their next move. So I'm going to give you a summary that I recently gave to a client in regards they have two condos in Richmond, so just south of Vancouver, British Columbia, and determining what that move looks like in regards to retaining those two condos versus selling and transitioning into a land asset, a single detached home. And then we also discussed being specific in regards to what type of home that we've had some recent zoning changes across the province allowing single family home to be redeveloped into a multiplex, so 4 or 6 units. So we did analysis of that at the end of the numbers as well. So let's get started. We're going to take a look at our process here. So 8120 Lansdowne Road is where the two condos are located at. Our objective here is to determine if there's a benefit to dispose of two-bedroom condo assets and acquire a detached home that can be developed at a future date. Steps and process we're going to take is we're going to identify the 5-year value of each condo asset, identify the 5-year value of a detached home. So we're going to determine if we retain the condo for 5 years, what does the financial landscape of that look like? Versus if we're able to sell these, get into a land asset, and what does that look like after 5 years? Compare the two reports, and then we're also going to look at the development value of a detached home into a stratified sixplex, which creates more of a 7-year plan. So first, let's take a look at the condo. So here's our Lansdowne address. Our purchase price, the value of the units in there at 788,000. We got a revenue monthly. So these are a two-bedroom condo. It's renting for 2450. These are a bit under market value, hence the tenants have been there for a while. Again, we're accounting for vacancy rate. Actually, the rental income is $2,500. The net minus the vacancy rate is $2,450. Again, expenses, we're looking at your mortgage expense. Now, I've determined what our monthly cash flow, just to create a positive cash flow of $126, just for your own information. What mortgage we would need to create a positive cash flow. Taxes, monthly condo at 525 strata fees, insurance. We're going to take a portion out of the rent to put into a maintenance fund if we need to take care of appliances or anything like that. We've incorporated the closing costs as well. Appreciation, we valued this at, again, I'm very conservative with numbers like these, so at 3%, and we're going to sell after 5 years. The debt is at all the numbers are based at 5% over a 25-year amortization. At the end of the day, what we're looking at here is our total profit of $119,000. That's for one of the units. So we're going to come back and look at the summary of that. Actually, we might as well take a look at it now. So right here, here's our condo. There's two units. And like we said here, $119,000, that's for one, times two for two units. So roughly, so 238,000 after 5 years. This 47,000 is two units after 1 year. Now let's take a look at the detached. And so this property currently for sale is on Ainsworth Crescent. Now the big deal about this property is that it has a laneway. To be able to convert the lot into a multiplex, it needs to have a lane. So I've identified that right now. So this is $1.8 million. The monthly rental income we've estimated at $4,300 a month. Create a positive cash flow of $187 per month. Again, looking at our expenses, our monthly mortgage expense at $4,000, which includes, so total expenses of $4,000, which includes a $2,700 a month mortgage, taxes at $388, insurance, and we've got a maintenance fund. Again, we're taking a portion in case the roof, appliances, any maintenance needs to get done. This is all monthly, and property management expense, incorporating closing costs. Now appreciation, we've bumped this up to 6%. Again, due to land value, we see much higher appreciation versus any condos. Sell after 5 years. Again, the same lending rate at 5%. And what we're looking at after 5 years is a total profit of $581,000. So let's take a look at both of these together here. And so again, here's our 1 year, and then we've got our 5 year here on the right hand side. Your condo making 238,000 versus your detached home at 581,000, we get a difference of $342,000. So ultimately, our discussion and to be able to switch these assets after 5 years, we're looking to be in ahead of the game by $342,000. Definitely worth the time to have a professional look at your assets and what the financial landscape looks like. Now, this is where it gets really exciting. So, the province of British Columbia has legislated in December that all single family lots can be turned into a fourplex or a sixplex. And the cities, it's time to ratify that. So, what does that look like? So, I've run through this pro forma statement that we're able to build. At the end of the day, we're looking at a profit even through a joint venture we are sharing at an additional $1.2 million. So this is, again, welcome to investment real estate. We want to be as efficient as possible. This is what I do on the daily. If you've got yourself a portfolio, let's take a look at it, let's analyze it, and come up with a strategy and make you an extra 342,000 plus 1.2, an extra 1.5 million in 5 to 7 years. Thank you so much. Have a great day.